real estate finance, I would want us to take 𝐂𝐨𝐻𝐼n's definition. 𝐂𝐨𝐻𝐼n's definition makes a lot of sense to me, and it's a simple one. It's a simple one. So 𝐂𝐨𝐻𝐼n tells us here that real estate is real property that consists of land and improvements, of course, on that land, which include buildings, fixtures, roads, structures, and any utility systems. To simplify it even much better, ladies and gentlemen, real estate, basically, we are looking at real estate as what? Land has to be there, plus any structures that are permanently fixed on the land. Any structures that are permanently fixed on the land. Ladies and gentlemen, I remember, like when I was getting some property of mine at Isinya. So I brought, it's a mortgage, so I brought in this case here some valuers from the bank. So these valuers came, there were some temporary structures there, mabati namna hii. So nilipoambia tafadhali simuongeze za hii structures, pia akasema hapana, we are considering what here? Any improvements on land which are what here? Permanently part of the land, like a borehole, right? Buildings, permanent fixtures, etc. So whenever we talk of real estate, we are looking at these real properties, which basically include what? Land has to be there. If there is no land, then straight away there is no real property there. So it has to be what here? Land plus any structures which are on it, which are permanently fixed. Now, when we talk of real estate finance, ladies and gentlemen, the question will be, how do we get to finance our real estate ownership? If you want to own some real estate today, what will you do in this case here? And return. If you want to own some real property, if you want to own a building in this town, how will you be able to finance your ownership of this building? Somebody, ladies and gentlemen, may get their savings over time. So basically, you could bring in what we call equity. So equity is key, number one. Number two, ladies and gentlemen, in most cases, you will not be able to afford a big building. Big buildings are very costly. Even small ones, they don't come in cheaply. So you could be having like 2 million, but your desire is to get a house of 10 million. So then what do? You have to look for a bank. So ladies and gentlemen, in this case here, we are talking of what here? Debt financing. And when it comes to this debt financing, for example, if you are employed full-time somewhere with a very good employer who has got arrangements for loans for their employees, you can easily go and get from this particular bank that has got an arrangement with your employer, you can easily go and get unsecured loan. So the loan is basically it's your employer who is guaranteeing kind of. It's unsecured, right? And then you come and invest this money in a building and then you pay gradually from your salary. But of course, ladies and gentlemen, for very serious real properties, normally the debt instrument has to be a mortgage loan. So under a mortgage loan, what happens under a mortgage loan? Under a mortgage loan, ladies and gentlemen, of course, in this case here, the bank will provide you with what here? A loan. But you see, if it's a mortgage loan, there must be collateral. There must be a security which will provide to this bank to give it some comfort. Of course, they are not in the business of coming to really steal your property or even sell your property when you do what? When you do, no, that's not their business. When you give them security, when you give them a mortgage, when you give them security, when you give them a collateral, ladies and gentlemen, basically you are giving them that comfort that you are financially stable, that if you fail in whichever ways, honoring your mortgage installments, they have got some fallback position. So under a mortgage loan, ladies and gentlemen, Under a mortgage loan, ladies and gentlemen, we are saying something very important here that you must always know, that there must be a collateral embedded. There must be a collateral embedded in your arrangements, collateral. So the buyer of the property is the one who provides what here? Who provides collateral. Very, very important. And remember, ladies and gentlemen, that when it comes to mortgages, normally what will happen, these banks will talk to you in advance before you sign the contract. They'll talk to you in advance. And you will see that they'll offer you two types. Of course, you have to choose. They'll offer you two types of interest rates. So we have got a fixed rate interest system, a fixed rate interest arrangement, and then of course we have got an ARM, adjusted rate mortgages, adjusted interest rate mortgages, if you wish, adjusted rate mortgages. So can somebody try to talk to us tonight and tell us, like they asked us last semester, November 2020, they asked us to differentiate between this fixed rate mortgage and adjusted rate mortgage. Last semester, they asked us to differentiate between a fixed rate mortgage and an adjustable rate mortgage. Can somebody talk to us tonight? Can somebody talk to us tonight? What is the difference between the two types of mortgages? Fixed rate mortgage, adjusted rate mortgage. These are some of things, if you're a good student, even without being taught by anybody, you will be able to use your finance knowledge to simply get all the marks here. But I'm not saying anybody. We are not saying anybody. No, Mary has tried. Mary has told us something very nice. And I want to imagine that you guys are taking your notes in some way. Of course, I'll be able to provide you with a handout, soft copy handout, but I would want you to be making your small notes in some way. And you can see this lady called Mary Njoroge telling us that in fixed rate mortgages, the rate of interest is normally predetermined. The rate of interest is normally predetermined and remains what here constant over the entire mortgage lifespan. So there is nobody who will come tell you, hey, Corona has hit, this has happened, that central bank has increased their base rate, that now we have to, no. We agreed in advance that for this particular mortgage, I'll be paying 13%. I'll be paying 13% throughout. Now, if you are in employment like where I work, we have a very good mortgage system. If, for example, you will be with them, for a good number of years, so long as you are with them, they have an arrangement with a bank. Our bank, in this case, if it's NCBA, will give us preferential rates as employees of my company, preferential 6% per annum. 6% per annum. But what will happen, ladies and gentlemen, is that in that clause, nowadays I take time. Initially, I never used to take time to read mortgage documents. Nowadays, I take time to read mortgage documents. I read everything, and they're bulky like this. I read everything. So if you're an employee, there'll always be that clause which tells you that this rate of interest is adjustable. Should you cease your employment with this particular company, your rate of interest goes to the market rate. So your rate of interest fluctuates. So if the rate of interest that you are offering to you will keep on changing, regardless of the circumstance, so long as the rate of interest is fluctuating within the scope of the mortgage, within the lifespan of mortgage, then straight away, your mortgage will be called adjustable or adjusted rate mortgage. You can see what Esther has here. ARM, rate of interest, varies upwards or downwards at the discretion of what the bank is. ARM is set below the market rate on a comparable fixed rate and then the rate rises or possibly lowers as time goes on, but I would prefer, Alice, please don't put the word fixed here at all. Don't put the word fixed at all there. Great. Great. Now, ladies and gentlemen, the other thing that you're supposed to be knowing in mortgages, and I told you this thing some time back, and it was tested last semester, this concept of what here? Recourse and non-recourse. Recourse and non-recourse. And non-recourse mortgages. Could you kindly speak through these particular terms with an objective of giving us the difference between the two? It was tested last semester, November 2020. Question number 3. It was tested last semester. Recourse and non-recourse mortgages. They're not talking to me. They're not talking to me. Remember, these are things that you did in CPA section what here? In CPA section 3. Recourse and non-recourse mortgages. Hey, my folks, please talk to me. Talk to me. Talk to me. Talk to me. And remember these things, even if you have done them in the normal class, don't assume that you know. My principle is always assume that you know nothing. And even the nothing that you know it wrongly until you pass your exam. Until you pass your exam. Until you pass your exam. I've seen a very good trial from Abdi. Abdi is a gentleman who happens to be in Garissa at the moment as we speak. Locked down there, but because of the online classes, he's able to get this content real time all the way from Garissa. Revolutionary. Actually, with this 5G, which is coming up, you'll tell me this thing is going to change how we operate 100%. I can only talk after I see your comments. 5 comments. Recourse, non-recourse. Bree, Breshi, Calvin, Christine Karaoke, Daniel, Dorcas, Esther Boy. I'm not seeing your points here. I'm not seeing your points here. Actually, the very best would have been for you guys to be unmuting yourself and then you talk to us. But now the problem is that some of us, we haven't known how to use this great technology called Zoom. In Zoom, when you come to Zoom, the very first thing you do is to ensure that first of all, your video is cancelled. Never have your video on not unless somebody insists. Never. That's key. Video number 1, ensure that your video is not on. Cancel it. Yeah, if you read newspapers like in the UK, there was somebody who was doing crazy things and his video was on. As a meeting was progressing, he lost his job. So video off. And then of course, in this case here, muting is always what here? A must. Obadiah has had that and decided now to put his video very well. Thank you. We shall overcome. Very good. So recourse. Let me see now what they have. Thank you very much. I can see 8 comments. That's a good number. So somebody is telling us here, let me start from the first one, which was given to us by Abdi. Under recourse, the lender goes for other assets of the borrower if he fails to pay the debt. I like that. I really like that. The name recourse. That should we have a situation where your collateral, your property which you had given to us to hold on to as security, During, in this case here, the time when you have defaulted, when we go to the market to sell your property, assuming you are owing at that time, you are owing us 10 million. And then your property, maybe there are dynamics, things have really changed. Your property can only give us 2 million. That means what? That there is a deficit, unpaid amount, debt to be owed still of 8 million. If in our clauses we had a concept of recourse means that now, if I was not able to raise my total amount, your property proceeds were not able to cover my total loan, ladies and gentlemen, what I'll do, I'll come back to you and tell you, look at this thing, you signed yourself, and of course, in this case here, you are more than 18 years, and you are not under duress during the time of signing. So because you signed here the concept of recourse, I'm coming back to take other assets until I get proceeds which are able to cover my entire loan, So recourse, I'll come back to you. If the collateral that you have given me is not able to cover the proceeds of that collateral, is not able to cover my entire debt, then I'll come back to you. But if it's non-recourse, I've always picked these things from those mortgage clauses. If it's non-recourse, if this person is not able to raise the entire amount, if it is non-recourse, as the name says, non-recourse, anashika kiguu na njia anaenda zake kabisa, haizi kuja back for what here my other assets. So, ladies and gentlemen, what does this non-recourse basically signify to us as accountants? As accountants, non-recourse means limited liability. That should anything happen, I'm only liable to the value of my collateral. Limited, I'm only limited to covering that. Should you not get adequate amounts to cover your funds, that is your problem. You can never come back to me. There is another term that I was very happy with, which they gave us last semester under mortgages, which very many students were not able to really define. A lien. You get people pronouncing it as a lien. A lien. A lien. Can somebody in this case here define this for us in mortgages? I'm so sure all of us here, we must be having mortgages. Is there anybody here who does not have a mortgage? Yes, my friends. Is there anybody who doesn't have a mortgage here? I'm waiting for, you don't have a mortgage. Benazir is a Muslim. For Muslims, I don't know whether there is something that is, you know, mortgages, of course, will lead to interest. And for them, interest is haram. What I don't know is whether if you go to First Community Bank, of course, they must be having Muslim compliant mortgages. Yeah. What we call the sukuk loans. And this is very common in your exams. The sukuk loans, very common. Sukuk loans in your exams, whenever you hear of this word sukuk, sukuk means what here? Islamic based. Loans which are offered on Islamic principles. Islamic principles. Remember, all Islamic loans, number one, in this case here, they don't allow interest, no interest. They don't allow any interest. And then number two, they are normally what here? Asset-backed. Asset-backed. They are normally asset-backed. You must tell them that if they are going to give you 100 million, in which asset are you going to put up this money in? Which asset are you going to construct this money with? What kind of business are you going to do with their money? Because they don't want you to take their money to any businesses here that sell alcohol, pornography, those things, bad things, right? So sukuk bonds are those loan instruments that we will use to raise funds, which are what here? Islamic compliant. Islamic compliant. Islamic, no interest. Interest or riba is haram. Riba is haram. And then there must be what here? Assets. You see, like the other day, our government issued out what we call the Eurobond. You must have seen Eurobonds in your exams. Eurobonds basically are a loan instruments that we use to borrow money from other nations, from other countries. Euro does not stand for Europe. No. Kenya issued Eurobonds to a country like Germany, Britain, USA. USA is not in Europe. Euro means foreign bonds. Bonds that you are issuing out there to get money from other countries. Preferably, the money you're getting from these other countries should be denominated in their currencies. Like there is a time we borrowed, in this case here, about 200 billion. Hii pesa ikakuja Kenya, ukaanza kusikia watu wanasema hata hawajui wameaccount namna gani. Nakumbuka siku hizo bado Raila alikuwa na nguvu upinzani, si kama saizi. Akasema 200 billion ikiingia kwa country, lazima utasikia harufu hata. Ili pesa ingekuwa ni sukuk bond, pesa kama yeye ingepotea. Sababu Waislamu wanafuata zaidi. Remember, Islam, I'm not a Muslim, but I normally do a lot of literature because of the consultancies I do, right, on these Islamic finance principles. Islamic finance, or rather Islamic finance, if you can recall, ladies and gentlemen, it's all about what here? Fairness. It's all about fairness. We don't want to lend you money and then you go misuse this money, knowing that this money at the end of the day will be paid by who? By taxpayers. So the lenders follow you to the level of knowing whether you were able to put up the assets that you had proposed to put up. So it's about fairness. And that is why they have got very good ways of financing. I would want you to go and do research on this. Islamic finance is really growing. Like now we have a very good model called Muduraba. Mudu ni mtu. Wanafuata Kiswahili sana, Yeah. So you get like two partners. So we have two partners. We have A, we have B. Partner B has got skills, business skills. He can run a business very well, but he doesn't have financial muscle. So he will look in this case here for a person called who? A, who is now a financier, but of course he doesn't also have what here? Business acumen. He can't run a business. So in this case here, this person who has got money is called a muduraba. So now they come together with who? This person who is kind of poor, but with very good business acumen. So they start a business together, and then all the rights and privileges of running the business is left for this guy. So if this business, for example, succeeds, they share profits equally. If, for example, they make losses, if the business makes losses, huyu mtu mdogo huwa agawiwi loss yeye. Sababu hana nguvu kama huyu mdu raba. Like that. Very good. So this kind of terminology we say like this, na kasi ni wakinipea chance ya kuset na mweka jina kama hii. Mtu akiangalia na sema ni finance ama nini, hiyo tumeshamaliza story. Like that. So very good. So you haven't yet answered my question. What is a lien? What's a lien? How many guys have? 14 of them. And I can see so many people are on the line. So we have Yaya, Musara. A lien is a right given to another by the owner of a property to secure debt, or one created by law in favor of certain creditors. I like that, but that is quite a difficult explanation. Ronnie is asking a very good question, but I would want to answer. They normally make, remember, for them, they don't go for interest. What they do, like I remember I borrowed something from First Community some other day. These people will ask you, what kind of business are you going to enter into? So you do a business plan, you tell them, this is the profit I'm going to realize. So you'll enter with them into what we call a profit share arrangement. A profit share arrangement. If you make, of course, a loss, but they want a lot of faithfulness. If you make a loss, of course, the bank is the muduraba. It absorbs the entire loss. If you make a profit, of course, you share with them. At the end of the day, that loan, especially if you are very, 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 very honest, at the end of the day, they'll gain more because their rates of getting that profit are very high. They can even tell you half. But you have to be very honest. Otherwise, if it's an African, or rather a Christian in most cases, will start charging the P&L with expenses which are non-existent. So that at the end of the day, we report a loss. So I'll be able to talk about that in another day, not today. I'm looking for a better definition. Nelly tells me, a lien, it is a right the lender has to take your property if you fail to pay your debt. Yes. Ladies and gentlemen, when your asset has been charged by a bank, if, for example, you have a big house and you decide to take this house to the bank so that the bank can leverage on it to give you money, you are basically surrendering your right to this house to the bank. So what the bank will do, they will charge the property. When they charge the property, they go to the Ministry of Lands, etc., and then they put a caveat. For example, you can never sell that house because effectively, for the time of the loan, that house does not belong to you. So under that caveat, you'll see that there is a lien saying that you have transferred all your rights to the bank. So the bank is now the one that will be having a right to sell this particular house, in the event that you are unable to meet your obligation to them. So when a house is under lien, you have to be very careful, because you're not careful, that particular house will go under the hammer, auctioning. Now, let me ask you a question. This is quite examinable. If, for example, this is a house of yours, you are taking a loan of 10 million, and you're not able to pay this loan back. When they take this house to auctioning, they get a buyer who gives them 30 million for that house. What happens with that excess money, 20 million? Can someone talk to me? Sorry, today I'm asking so many questions. So remember, you owed them how much? 10 million. And your house, of course, has been under a lien, a charge. So when they go selling your house, perhaps this house of yours is in current. They get a buyer. Who is able to give them much more than you owed them. They give them 30 million. So there is an excess of 20 million. Thank you very much. Now, ladies and gentlemen, please allow us to mention there, that there are 3 methods of valuing properties. So valuation of real estate properties. How many methods do we have there? 3. So there are 3 different approaches. By the way, are you able to see my screen? Thank you very much. So there are 3 approaches. And one of them is called the income approach. So this income approach, I don't even want us to go through the model, because it's basically what I've taught you. And the net income approach, ladies and gentlemen, basically, first of all, we must know that for purposes of valuing properties, we prefer, under the income approach, not unless the examiner tells you to use the net income. Like the other semester, but one, the examiner told us specifically to use net income to value properties. Under income approach, ladies and gentlemen, under income approach, we always prefer what we call NOI. NOI is net operating income. If somebody asks you today to define net operating income, what will you tell us is net operating income? How will you define NOI? 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 I can't be getting answers from the same students. No, that one I refuse. I refuse that, the way I refuse to go to hell. I have to get answers from everybody, from everybody. Like I can see Flo, I can see Felix, I can see Felicitas, I can see Grace. You know, Grace is a very good name. But please, that goodness, let that goodness be seen here in the comments. In the comments. If I can't see your contributions in my comments, then straight away, I'm going to declare you hostile. I'll declare you hostile because, you know, you have a very big search engine in the name of what here? In the name of Google. In the name of Google. In the name of, you simply Google. Things have really been brought to our tables. Ours is to pick and consume. So when we talk of net operating income, somebody, if you go to an interview today, Obadiah, and somebody asks you what is net operating income, what will you say is net operating income? Very good. There is a lady here who has finished the entire thing. This lady is called Alice. Alice has known that operating income is EBIT. Don't add anything else. Yeah, even this one, operating income to determine the value of a farm. Nevertheless, remember, it will be very important for you. Yes, they've even gone ahead to give me the formula. The most important thing, ladies and gentlemen, is for you to know that net operating income is the same as profit before interest and what here? Tax. Profit before interest and tax. So, ladies and gentlemen, if you are given this kind of information here, calculate net operating income using the following information. Let me try hiding the solution because I'm so sure there must be somebody who will want to steal my solution. So they have given us the property type. It's an office building. They have given us property size, 200,000 square feet. We have gross rental income of shillings 25 per square foot. We have other income of 75,000. We have vacancy and a collection loss of 5% of total rental income, property taxes and insurance, 350,000, utilities and maintenance, 875,000. Interest expense is irrelevant. And operating income, interest expense is irrelevant. Income tax is also what here? Irrelevant. So then how do we compute this? This is quite a simple thing. Very simple thing. This is quite a simple thing. So you can see the property size here. It is 200,000 square feet. And the rental income is 25 per square foot. So could you kindly give me this gross rental income? Give me the gross rental income. The gross rental income, that is very important. It's a profit and loss account, remember. So we have gross rental income. So gross rental income, ladies and gentlemen here, thank you very much, Lokai. Gross rental income will be the 200,000 times 25, thank you, will be 200,000 times 25, 200,000 times 25, then you can see somebody is giving me a figure of 5 million. So this is what we are able to raise from what here? From tenants. But now remember, if, for example, this office block of yours is located in a very good place, at times you will issue out leases to people who would want to advertise. These tenants, when they want to put their names out there, you should be able to charge them some rental income as well, right? You don't always get, for example, you could be having so many ways of getting money when you have got what here? Some property. So that will fall under what we call other income. So you can see the other income here is 75,000. Other income is 75,000. So other income Other income is 75,000. Is 75,000. So please come and give me the total rent. The total rent. The total rent. Total rent. It will be 50, 75,000 like that. But now remember that this is what we call the potential rental income. For those of you who would want to enter into this real estate business, it's also a tricky one. Please do your own research before just jumping in. I have a few friends of mine who just jumped in without doing a lot of research on this. So what will happen? You will get a big percentage of, for example, your house being vacant. Or at times you get very bad tenants who know the law, right? You go, in this case here, you pretend you know the law yourself, as many landlords don't know the law. So you go closing or breaking the house. And then somebody goes and says in the rent tribunal that there was 500,000 in that room. It will be very hard for you to convince people otherwise that you never took that money. And remember, this is a person who has not been paying you any rent for the last even a whole year, but saying that in his house, he had half a million. So there will always be the vacancy issues. Like now here, we are told that there is vacancy and the collection losses of what percentage? 5%. So vacancy and collection losses of 5%. Remember, it is 5% of the potential. This is where most students go wrong. It is 5% of the potential. So 5% of 50, 75,000. Because even these guys who have put their names outside there for advertising, on the advertising boards, if they're giving you trouble in terms of paying you rent, even this amount is at risk. You can't collect the whole of it. You can't collect the whole of it. So somebody called Phoebe gives me 253,750. Are there any other expenses? Are there any other expenses? Oh, yes, we have them. We have other expenses. We have other expenses. Like now we have here operating. Look at this. We have the next one is property. Property. I don't know why it is not here, but it should be here. It should be here. Property taxes and insurance. This is a good tax. This is a good tax which has to be deducted. The tax that we don't want you to deduct in ascertainment of EBIT is the income tax, the 30%. But if there are taxes to do with what here, the property, the ones that you pay to municipal council, to city council, county government, that tax is normally allowable for the major tax. So in this case here, come and deduct property tax and insurance. Property taxes are what we call the land and or rather the rates, land rates. Those ones are normally allowed. Don't say that in calculations of NOE, Mwalimu say that we don't deduct any tax. No, it's the income tax that we don't deduct. So property tax and insurance, what do we have here? Property tax and insurance, ladies and gentlemen, property tax and insurance, we have a figure of 350,000. A figure of 350,000. 350,000 like that. And then the last one that I'm able to pick from there is the utilities and maintenance. Utilities and the maintenance. So utilities and the maintenance, what amount are we able to see here of 875,000? 875,000. So could you kindly subtract this out? Kindly subtract this out. Don't bring in the issue of interest. Don't bring in the issue of income tax. Don't bring in the issue of income tax. So then give us the net operating income. Tell us whether it is this amount here, 35, 96, 250. 35, 96, 35, 96, 250 every year. So this is what we call EBIT or straight away the NOI, the net operating what here? Expense. The net operating expense. The net operating expense. The net operating expense. Thank you very much, Grace. Thank you very much. Thank you very much. Thank you very much. Great. Now, ladies and gentlemen, this NOI now is what I will be using to value my properties. Once you tell me that this is the NOI that I expect at the end of year one, I'll tell you, fine. Now, in this case, you have to value this. First of all, I'll be able to make an assumption that this particular property will be with me indefinitely. Indefinitely, in perpetuity. So I'll be treating this amount here as what here? As a perpetual, as an annuity. As an annuity. And if it's an annuity, what do I need to do? I simply need to take this amount I divide by the capitalization rate. I divide this by the cost of capital. Let's look at an example. Now, ladies and gentlemen, if, for instance, you are given, look at this question. Assume that the net operating income for an office building is expected to be 175,000. And the capitalization rate is 8%. Is 8%. Estimate the market value of the property using, they don't even have to say that really. It's not net operating income. It's net operating income. The moment they give me the net operating income, then I will be able, ladies and gentlemen, to really give you the value of the farm. Who is able to see the value of the farm through direct calculations. Don't look at the answer which is there is wrong. I'm waiting to see whether there is anybody who will be able to give me an answer. Is there anybody who will be able to give me an answer there? Is there anybody who will be able to give me an answer? You have some building that is you are expecting to give you 175,000. And then they have given you the cost of capital there of 8%. Of 8%. Now, ladies and gentlemen, this is quite a simple thing. Let me show you how to do it. Let me show you how to do this. This is a very direct thing. First of all, an examiner who gives me net operating income is an examiner, ladies and gentlemen, who is wishing me success. Who is wishing me success. Because now I don't need to do any computations of NOI. The NOI has been provided to us. It's 175,000. And then they have given me the cap rate of 8%. And then they want us to give them the market value of the property. The market value of the property. So then I'll talk of NOI 1 all over R. When I say NOI 1 means what here? Expected. 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 At the end of the year. At the end of the year. At the end of the year. So the NOI here is 175,000 divided by R. R, which happens to be 0.08, like that. So 175,000 divided by what here? 0.08. So you should be able to give us the answer. Please give me the answer. Please give me the answer. Great. 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 How about this example here? Look at this example. We are told here because of existing leases, the NOI of a warehouse is expected to be 1 million per year over the next 4 years. Beginning in the 5th year, NOI is expected to increase to 1.2 million and grow at 3% annually thereafter. Assuming investors require a 13% return, calculate the value of the property today, assuming that the warehouse is sold after 4 years. Could you kindly copy down that question? Copy down that question. Put it down, put it down, put it down. Copy that question, put it down. May take you a few minutes. And once you finish, please shout yes. Yes, we are through. I'm not seeing any yes anywhere. Yes. Yes. So one more minute, one more minute. One more minute, one more minute. Great. I can see 2 yeses out of 50-something yeses. Now, ladies and gentlemen, could you kindly talk to me? When you read and, of course, wrote that particular question down, what came to your mind? What came to your mind? If you got that kind of a question in your exam this time around, May this year, 2021, if you get that kind of a question, how will you be able to handle it? Thanks, Marion. If you were to get that kind of a question, will you simply put up your hands and say, I'll not write anything, and I'm going to return these 𝐭𝐶𝐻 papers just blank like that? The only thing that some students are very good at, and I normally see this whenever I mark at 𝐭𝐶𝐻, I always see students who leave their papers blank almost 100%, but they never forget to write one thing: God bless the work of my hands. Benaziri ndiye amejua. Benaziri ndiye amejua. Amejua namna gani? Huyu Benaziri huyu nafaa nimwangalie kando. Good try, yo. Benaziri ndiye amejua kitu fulani kwamba akiona mali amepatiwa rate of interest, discounting rate, na kuna growth rate mahali, ya ameshajua straight away that we must make use of provincial officer. Provincial officer has to be used somewhere. Provincial officer must be used somewhere. We must make use of the provincial officer formula. But who is able to remember the provincial officer formula? Who is able to remember the provincial officer formula? Who is able to remember the provincial officer formula? At least you can see like now what Mary is giving us. There is a growth rate. There is a growth rate. Great. Thanks very much, Mary. Mary, thank you very much. Mary happens to be the name of my mother. Thank you very much. Bernard Kirui, today you have been very silent, but better late than never. Better late than never. Waswahili nasema kwanza kwamba mwisho mwema. Mwisho ni mwema kuliko mwanzo. Oh, okay. So, ladies and gentlemen, I would want you to go and try that question on your own. On your own. I can give you an answer. I can give you an, just take the answer alone. Just take the answer alone. I'm so sure there must be somebody who is trying to screenshot this. Don't just take the answer alone. Just take the answer alone. The answer alone. The answer alone. The answer alone. 10, 3, 3, 4, 100. Great. So once you finish that, then automatically now you will have mastered this concept of valuing a property on the basis of, as an investor, what incomes will I be getting? What incomes will I be getting? Once I have those incomes, then I discount them. So right there, method number two. Remember, our next class, I don't know whether it's tomorrow or when, I'm yet to look at that timetable, our next class. So make sure that you finish that question today. If you don't finish that question today, in our next class, which I'm not so sure whether it will be tomorrow, we shall punish you. And our punishment is very bad. We'll simply ask you to bring your parent to the school. And remember, school here now is Zoom. You bring your parent there, we talk to your parent as a class. We tell the parent that this person does not do their homeworks at all. Great. So screenshot of the question, please do that very fast. Do that very fast. Screenshot of the question. It's given there. Screenshot of the question. Take that screenshot very fast. Take that screenshot very fast. Take the screenshot very fast. Great. So now, if you allow me, I'll look at, in the next 2 minutes, I will look at a very important approach of valuing properties called sales approach. Second method, this is called the sales approach. Sales comparison approach. Sales comparison approach. So, ladies and gentlemen, in this method, what we normally do before we buy a property, we'll ask ourselves, in this area, this vicinity, is there any property that was just sold the other day? Right? Are there, for example, companies which can provide this kind of information of the properties of this particular type, of this, for example, residential in nature, that have been sold, say, for the last 1 year? So if, for example, I want to buy property A, what I'll need to do is to look at just the vicinity here and ask myself, is there any property that is quite similar to A, which I'm calling here A with a hyphen up there, which has been sold in the recent past? If, for example, I realize that A was sold for 10 million Kenya shillings, then through sales comparison, I'll be able to say that A should also not cost more than that. A's value should be around that. But now remember that this is A with a hyphen, meaning that it is not exactly the same as what here, the same as A. Not exactly. Perhaps A could be having an additional bedroom. Quite similar, but this has 4 bedrooms. This has got what here? This has got maybe 5 bedrooms. So in sales comparison approach, after I've gotten this comparator, it will be very important. It will be very important, ladies and gentlemen, for me to make some adjustments to fit my exact type of the house that I'm looking for. Perhaps, ladies and gentlemen, this particular house here had used on the floor. For example, they had what we call the floor packets, right? These wooden, beautiful mahogany packets, very nice. But the kind of a house that I would want to buy here has got what we call a resilient floor. A resilient floor. This perhaps could have heard, even to make it easier for you, what you guys understand. Perhaps in this case here, we have, everybody knows what PVC tiles are. Cheap tiles, right? But my floor, ladies and gentlemen, here happens to be a resilient floor made of mahogany timber imported from Congo, Brazzaville. Unajua maisha ni funny sana. Mimi kuna mahali nimeenda because of my background. You know, maybe I've never told you, my undergraduate is civil engineering. So I've been involved in some constructions. So kuna mahali unaendanga, unaona mtu ameweka floor resilient. Floor resilient, ile floor unakanyaga hivi unasikia na spring. Unasikia ni kama roho inashuka kidogo. Kuna watu nani wanaishi. Wengine ni kama tunasindikiza hawa. Unaona? Right? So if it's a resilient floor, of course we expect a resilient floor given the kind of mahogany that it has and the kind of springs that they put to support that particular swing. Swing mzuri, unatembea unasikia mzuri sana. Like that. So unakuta, ladies and gentlemen, kwamba hii resilient floor, I must make what here adjustments for me to be able to come up with the exact value for this particular what here farm A, for this particular farm A. Ladies and gentlemen, there could be very many changes. There are houses you go to. Unapata mtu amekuambia nyumba yangu mimi nataka ikuwe na balcony ya 1.8 meter timber steel, resilient. In the master bedroom, 1.8 is quite long. Inaitwa a dancing balcony. Mahali mzee akiwa na Sunday amepumzika mzuri, anachukua kiti na kaa huko nje, akisoma gazeti, anaswing namna. That of course adds on to the cost of what here, this particular building, the cost of this particular building. So ladies and gentlemen, because of time, I would want to pick it from here in our next session.